right, so let's look at McDonald's CFI. So once we build our valuation model over the next couple weeks after the midterm, one of the things it's going to do is it's going to give us, for real companies, historical CFI. So in our model, we'll have 5 years of historical CFI, and then we'll have a column called total, which sums up the previous 5 years, right, to give us kind of a sense of the average of what's going on. And then we'll look at the trajectories of the 5 years that lead to that total. So we'll start out with the total column and do the exact same process. So number one for McDonald's, we start with the concept of free cash flow. So what do we know about McDonald's based on their free cash flow in the total column for the last 5 years? What do we immediately know? Is the free cash flow positive or negative? Positive. So McDonald's generated $23.9 billion of free cash flow over the last 5 years. Right? So they've generated a lot of cash, much more than they reinvested in the business. Number two, what's their reinvestment rate averaging for the last 5 years?
31.7.
Yeah, 31.7%. All right. Now, let's look at some trajectories. Is anything changing about the reinvestment rate over the 5 years?
Significant decrease the last 2 years.
Yes. And not just decrease, it went from almost 50% down to 10.6%. So they've really dramatically slowed their reinvestment, particularly in 2014. So let's look at their NOPAT. Let's look at their profits from operations. They had almost $28 billion of NOPAT over the 5 years. Did anything change about that trajectory over the 5 years?
Went down. It's pretty. Looks like it went up to about 2012 and then peaked in 13, but by 14 it's like almost $1 billion decrease.
That's right. And that isn't only $1 billion decrease in 2014, it's less than where they were in 2010. So by 2014, their profits had come down. So think about this. Does it make sense to build a lot of stores if our profits are starting to come down? And why might they want to stop building a lot of stores? Right? Think about McDonald's today. They're having trouble with same-store sales. They're having trouble with people coming to their restaurants. I'm telling you, this was foreshadowed in their 2014 CFI. Because you saw about, as you said, almost $1 billion decrease in their profitability after tax. And you saw them dramatically scale back on growth. Because they're not only going far less than the average, they cut back to 10%, which means they're barely reinvesting in their business. Well, why would I not want to reinvest? Because I don't really think I need to grow. Why am I not growing? Because nobody's already coming to my stores, and I'm making less money on my stores. So I'm saying some of the problems with McDonald's were already showing up in their CFI last year. Okay. Now, here's what's interesting. Look at the non-operating section. What did they do with their non-operating cash flows? What happened to excess cash over the 5 years? Negative 188. What does that tell me McDonald's did?
Overall, their excess cash increased, but they're starting to burn through it.
That's right. So that's the point. Their excess cash increased. Now 188 relative to 23 billion. It's a pretty trivial amount. But as you said, the trajectory is 2014, they actually started taking out some of their excess cash to add to their CFI. Okay, so that's how they turned $6 billion of free cash flow into $7 billion of CFI. All right, but even over the 5 years, the other thing they did is they did make some investments in non-operating assets. They did generate some cash by selling off some non-operating assets of $1 billion, was it 97.2, giving them almost $25 billion, 24,757 of CFI. What did McDonald's do with the cash? What did they do with their debt and equity? What did they do? What happened to their debt? I mean, they paid $1.7 billion in interest, but what happened to their debt? It increased by how much? Yeah, almost $4 billion, 44.11. So let me ask you the same question I asked in the hypothetical company. Did McDonald's need to borrow that money? No. This is discretionary. Why might McDonald's want to borrow the money? Well, look down the equity section. They paid out $14 billion worth of dividends, and they bought back almost $14 billion worth of stock. So they basically gave $28 billion to the shareholders. Well, they only had $25 billion of CFI. They had to borrow the difference. Now, here's what's interesting. Profit trajectory was down 2014. Reinvestment slowed 2014. Free cash flow went up because they stopped investing. So in 2014, McDonald's generated free cash flow because they stopped opening stores and stopped reinvesting in their stores, even though their profits were down. And McDonald's continued to increase their dividends. So I could look at this at the press release, and McDonald's could say, look at how we're rewarding our shareholders. Look at all the shares we're buying back. And I don't buy it because I'm looking at the underlying cash flows, and they're not going at the same direction as the payout. And it's not sustainable at the rate that they're paying out because they're doing it by not investing, and they're doing it by borrowing money. And so it's really at the bank's behest that they're able to pay this out. Because I'm taking it from the debt holders and I'm giving it to the shareholders. It's not that I'm making money and distributing it all. I'm giving more than I make. In a way, I'm masking my problems. Now here's what's interesting. If you have a Bloomberg terminal open, go to MCD US Equity, go to EEO, and on the earnings estimate, look at the forecast for McDonald's return on equity. You will see that their return on equity goes from like 40% to 60% to almost 80% over the next 3 years. That's the share buyback. So what McDonald's is saying is, look at the returns on equity that we're getting to our shareholders because we're basically eliminating the stock by buying it all back. What a great company we are with our return on equity. But I'm telling you that that is masking the inherent problems we're seeing in their cash flow, right? Because the performance of the company is not getting better. The returns of the shareholders are getting better because they're manipulating their balance sheet and they're distributing a lot of cash, right? But the amount of cash that they have available to distribute is coming on the fact that they've stopped investing in more stores, and they're doing it while their profits are coming down and starting to decline. And that got tougher in 2015. So what I'm telling you is, to me, I start looking at the story and I'm thinking about McDonald's valuation. And they're trumpeting, look at our great return on equity, look at all the stock we're buying back, look at the confidence we have in our company. And I don't buy the confidence in the company because you're not building more stores, you're not doing CapEx investment, and you're not making a profit. Not nearly at the level that you're doing. There's pressures there on your business side. So, let's talk about Chipotle. Same analysis. I'll give you a minute. Look at Chipotle. Tell me what's going on with Chipotle. Because as I said, you are going to have to do this as an essay question on Wednesday. This will be part 2 essay. One of the questions. I will give you a company, a real world company that looks like this. It won't be these two, it won't be this industry, and you will have to do and write out this analysis. So look at Chipotle. We just did McDonald's. Give you a minute to kind of look at it, digest it, and then see if somebody wants to give me a compare and contrast. What do we learn about Chipotle by doing the CFI? So anybody want to try and take a crack at this for practice? What's going on with Chipotle's free cash flow? Yeah.
So, in essence, it's a trajectory of growth and a lot of capital expenditure. So they open more stores, so they don't have anything.
Okay, so let me slow you down. As you're going through this, like I said, use numbers. So don't just make the general statements. Like, use the numbers so I know how you can make the supporting conclusions.
2013, you had 2018 million, 2014 295 million free cash flow. And as far as the capital expenditure, you also see the jump from 192 to 254.
Okay, so look at the total column. You see Chipotle has almost $1 billion of free cash flow, 968.9 positive, right? As he pointed out, they have 100 billion four of no plat and gross cash flow of almost 1.9 billion, and their no plat almost doubled, a little bit more than doubled between 2010 and 2014, and pretty much is increasing every year, including 2014. And their capital expenditures in dollars has been increasing just about every year, including a big increase in 2014. And the reinvestment rate, which is average 48%, much higher than McDonald's, they didn't really slow down that much in 2014. They still put 47% of reinvestment back into the business. Right? So again, you start to see a compare and contrast different with McDonald's. McDonald's profits are declining between 2013 and 2014. McDonald's is slash store investment. Chipotle is going the opposite. Their profits are increasing, their reinvestment's increasing, and here's the other thing. All of their reinvestment is being paid with their free cash flow. They have enough free cash flow to cover all of this reinvestment, and they don't need to borrow any money. So they're funding all of that very positive, very profitable growth, and they still have free cash flow left. So then let's talk about what do they do with their free cash flow. What did Chipotle do with their excess cash? They banked it, as somebody said earlier. They took about half of that free cash flow they decided to put in the bank. They took the other half and they put it into something non-operating. We don't know what it is, but maybe we could do some investigation and find out. Which meant their CFI was really not too high, 139.7. Look at the debt. There's no debt. Chipotle doesn't need any debt. You can see that very clearly. They are taking half their free cash flow and increasing profits, they're putting it back in the business, and they can comfortably support it with all the profits that are happening in their business. That's not the story of McDonald's. They don't need any debt to do this. They're self-funded. Now, what are they doing on the equity side? Are they buying back some shares? Yes. They're also issuing some shares. So this one, to me, seems a little bit odd because they don't really need to issue shares. They have the cash, but yeah, they're issuing shares and buying back simultaneously. Why are they doing that? That's a question for management. Right? I would ask them that. And I don't know the answer without further investigation, but I'll give you a suspicion that I've seen with other companies. I reward my leadership with stock and stock options. So what I want to do is I want to inoculate my shareholders from dilution. So what I'll do is I'll buy back the shares that I'm giving to my employees so that way the shareholders are not diluted. I'm not saying that's what's happening here, but I'm saying that's what could be happening here. And that's what I mean. This is where I then, as a good analyst, could go do some investigation, ask some questions. But what I really know is that the trajectories of McDonald's and Chipotle are far different. Right? I get good warm fuzzies looking at what's happening with Chipotle. I don't get that with McDonald's when I really see what's happening with the business. And what I'm really telling you is look how much information that we have uncovered now that we have the CFI in this format. Okay? So that's what I'm telling you. There's a wealth of information that by reorganizing it into a more consistent way that will really help us with with what I call the story of the business. Particularly, we start comparing and contrasting peers. Okay? So, this, as I said, will be one of the essay questions on the midterm exam next week. Questions about any of this? Any comments that we made? Any conclusions that were drawn? Yes?
What would a adjustment equity be?
That's the problem. I don't know. Because that's that, catch-all AOCI. It's really the plug. And so I don't know what the accounts are doing there. So it could be there's a write-off of something. So it could be a write-off. It could be a disposal, gain losses, equity adjustments there. That's the problem is I just don't know, right? So that's why, to be honest with you, what we really want to do is we start digging through the 10Ks and the 10Qs, right? We'd start looking for explanations of what's going on with the changes to the equity. Or we'd look at that fourth accounting statement that nobody ever looks at, which is change the statement in earnings, right? So again, because the statement has the balance, this is also, for CFI purposes, sort of a balancing equity account, okay? But regardless, what I really want to focus on particularly is buying back stock, issuing stock, paying dividends, paying interest, issuing debt, repurchasing debt. Those are my most important categories that I'm going to focus on. All right? Good question. By the way, the other thing could be is if you do an acquisition, you could use stock to pay for the acquisition. There could be some equity adjustments associated with that. But again, I just don't know off the top without digging deeper. All right? Other questions? All right. Statement number 2 of analysis. ROIC tree. I'll go back to McDonald's. So the other thing you're going to have to analyze, and this will be a second essay question on Part B of your midterm exam, and core to second half of the semester group project analysis, is these things called ROIC trees. And the point of the ROIC tree, as was defined in the book, is to help you understand the drivers of ROIC and the changes in ROIC that these drivers are telling us are occurring. Okay? So when we create the ROIC trees, you'll see it says on the sheet EOY. All right, this is end of year ROIC as opposed to the BOY, beginning of year ROIC. For purposes of the midterm, you're not going to have to calculate this tree. I'll give you the tree. All right, but it'll be based on end of year ROIC. Now, the general idea here is we're going to have 5 historical years of ROIC. Right? There are 3 things, always 3 things, that explain the changes in ROIC. So that's the analysis that you're going to be required to do. So for McDonald's, in 2010, their ROIC was 21.8%, and it went by 2014 to 18.9%. That was a 13.6% 5-year decrease in ROIC. 3 things will affect the ROIC. Number 1, the tax rate. McDonald's tax rate went from 29% to 35.5%, an increase of 21% in the tax rate. So obviously McDonald's was hurt by paying more taxes in the ROIC of the business. Right? So that's one of the reasons why McDonald's has a lower ROIC. Now, taking out the impact of taxes, the underlying business would be the pre-tax ROIC. And their pre-tax ROIC went from 31% to 29%. So despite the higher taxes, they still had some business challenges. Right? And we're seeing that in the drop in pre-tax ROIC of 5.4%. 2 things drive pre-tax ROIC. These are number 2 and number 3 to your analytics. 1 is operating margin, operating profit divided by revenue, or EBIT divided by revenue. So the operating margin of McDonald's went from 31% to 29%, a 7% decline in operating margin. So one thing we can clearly see about McDonald's, their profitability is lower. Their margins are down. The third item is productivity. In 2010, to generate $1 of revenue, they invested $1.05, $1.50. In 2014, to generate the same $1 of revenue, they only had to invest 99 cents. They got a slight improvement in their productivity, by about 1%. So a lower number is better. Except here's the thing. For McDonald's, what really drove their ROIC lower wasn't really a change in productivity. Productivity stayed the same. What really hurt McDonald's was the declining margins. So very clearly, I can trace a path to the declining operating margin to the declining ROIC for McDonald's. In fact, I'll go to another path. It's not surprising to me that their no plats are coming down, and it's not surprising to me that with the declining margins, that they're starting to question whether they want to keep opening up a bunch of stores. Now, here's the next thing. Second level analysis. What's causing the operating margin to decline? What's causing the productivity to change? Well, off the income statement, it's either gross margin, SG&A as a percentage of sales, or depreciation as a percentage of sales. My gross margin didn't change. It went up. It went from 45 to 61. So one could argue that McDonald's is putting higher priced merchandise on their menu. But their SG&A went up even more. They went from spending 9 cents in SG&A to 26 cents in SG&A. So they spent a huge amount of money to justify the higher prices, to market, and to get people to come to the McDonald's. So here's the guess. The reason why the SG&A as a percentage of sales went up much faster, I spent the money, it's a fixed amount, I didn't get the increase of sales that I expected, my SG&As as a percentage went way up, my margins are declined. So that's the point. I spent a lot of money to grow my sales, I didn't get the growth with the higher margin merchandise. So McDonald's is not about the margin of the items on their menu. McDonald's real problem is they're spending a lot of money to grow and people aren't showing up. Which is why it's not surprising when we go back to the free cash flow statement that they stopped investing and opening up more stores, because it doesn't make sense to spend a lot of money to get people to show up and they're not showing up, and I don't want to open up a bunch of stores that are half empty. So you start to see a tie-in between what we're seeing here very clearly on the CFI and what's happening on the ROIC tree. By the way, the third piece is what's happening with the productivity. 3 things off the balance sheet. How much am I spending on working capital? How much am I spending on PP&E to sales, which is influenced by CapEx? And what am I spending on intangibles and goodwill? Well, working capital, I spent a little bit more money on working capital, even though it was negative, it was slightly less negative. So that hurt my productivity. My PP&E to sales went from 92 cents to 89 cents. Right? So the point is, in the last year, my productivity seemed to increase. And I really didn't change much in intangibles, so not a lot of acquisition. So that's the point. McDonald's, when they slowed their spending and stopped opening stores, they did it to maintain store productivity. And they'd spent a lot on SG&A, probably to drive volume. So what I'm telling you is, before what's happening in today's headlines in 2015, that we're seeing in the Wall Street Journal about all their problems with growth, they're right there in the CFI starting to manifest itself a year ago. Because what you're seeing is they're slashing their expenditures on CapEx. They're maintaining their productivity by not spending. They spent a lot in SG&A, which usually is probably to drive the volume. They didn't really get the volume that they expected. It's put pressure on their business, which is also because even though they have higher margin merchandise, they're spending so much to sell the higher margin merchandise, it's offsetting itself. And now they have a problem. But what it tells me when I get to my valuation is they're probably going to have a growth problem. McDonald's is a growth problem. It's not a margin on their food problem. It's people aren't buying the food that they're trying to push at the levels that they need. Now let's compare and contrast that with Chipotle. So look at Chipotle's ROIC tree. What do we see with Chipotle? Well, their end of year ROIC went from 26.6% to 41%, 40.8%, an increase of 53%. Their tax rate actually went down from 38 to 37.6. All right, not much, but basically all of the increase in ROIC was pretty much pre-tax, going from 43 to 65. Chipotle's operating margin went from 15.7 to 17.3. So Chipotle is actually increasing its operating margin, and their productivity is improving dramatically. They went from spending 36 cents to generate a dollar of sales to only having to invest 26 cents to generate a dollar of sales. When I look at the margin of Chipotle, their gross margins were pretty consistent at around 30%, 30.4 to 29.9. What's interesting is Chipotle's SG&A spending went from 11 cents to 10 cents. So that's the point. McDonald's spent a lot on SG&A and it hurt their margin. Chipotle is increasing their margin because they're getting productivity from their SG&A. What I infer that to is my spending in SG&A is fixed, my revenue goes up, my percentage goes down. Chipotle is in growth mode. We saw that in the CFI. Right? It makes sense that they want to keep reinvesting in opening stores. It makes sense that they're making much more profitability. And that's the thing. McDonald's spends a lot of money. Nobody's at McDonald's. Chipotle raises their prices. McDonald's raises the prices. McDonald's doesn't attract a lot of people. Chipotle raises their prices. The lines get longer. Right? And that's the point. They are really hitting on all cylinders here, and you're seeing it in their financials. Now, on the productivity side, you can also see it. Working capital is not changing, but store productivity is, because net PP&E as a percentage of sales went from 37 cents to 27 cents. And again, tied to the productivity of the SG&A. So with McDonald's, I can try a direct link between the SG&A problem, their drop in margin, and their drop in ROIC. Chipotle is the exact opposite. Chipotle is getting better SG&A and better net PP&E to sales, both of which are contributing to their ROIC going up by 50%. That's allowing them to fund, back to the CFI, all of that growth with internal funds. And now I start to understand the difference in those two potential investments, right? And I see the different trajectories of those companies, right? That's what we want to get out of the analysis of the rearranged economic statements, right? So I'm assuming that you guys are not asking a lot of questions because you're pros and you will have no trouble doing this, right? But if you do, and it's just because there's a video going on and you're afraid to be memorialized on YouTube, I'm going to stop the video in a second. I'll post this online, but I will just tell you 2 of the 9 to 10 questions on the midterm will be this. You'll have to do a CFI, you'll have to do an ROIC analysis, and you'll have to cover all 4 sections and do it essentially the way we just did it here in class. All right, the videos will be live. So again, Monday, Wednesday, part A, part B, take it anywhere, do it during your assigned time. Okay, the following Monday, the 2 p.m. section will have a guest speaker from Morgan Stanley. The rest of the sections will build the Excel model. For the 2 p.m. section, you'll still have to build the Excel model, just have to watch the video separately. Okay? All right, have a good day.
Just want to confirm that it's okay if I turn in the assignment for bring that on Friday.
Let me just save it. So it's not recording your question here. So who are you again?
Sorry?
So are you doing it because you had an
Yeah, the
extension?
holiday was out.
Okay, so you have an excused extension because it's religious holiday.
I spoke to you before, but is there
Yes.
something I have to like?
Well, I'm giving people extensions with the paper to turn it on Friday, but you don't have to do the paper because you have an excused
Should I
extension.
mark on the bottom that I?
What you're going to have to do is you're going to have to email it. So just submit the email and just say it was because of the holiday, the religious holiday. But yeah, just email it by 5 o'clock on Friday.
Awesome. Thank you very much.
And copy the TA. Like figure out which one of your people are your TA, copy me and the TA by 5.